Assalamualaikum warahmatullahi wabarakatuh. Here I'm going to review from the previous video that I've been watched before. And the subject is risk and return single asset. The first one, we have several points. Risk define, risk preferences, also this risk of a single asset standard deviation, and risk of a single asset coefficient variation. Okay, we will turn to risk and return single asset. When we invest, our target is to make a good return. Return represents the total gain or loss on an investment. The most basic way to calculate return is as follows, in which we take cash flow received plus ending value minus beginning value over beginning value. Ending value is a selling price while beginning value is the purchase price. The difference between purchase and selling prices is called capital gain. So this formula can also be expressed as return equal to current income plus capital gain over purchase price. And there are two types of return can be calculated. The first is expected return. This is the return that an investor expects to earn an asset given its price, growth potential, and so on. The expected value of a return, R bar, is the most likely return of an asset. And the second one is required return, the return that an investor requires on an asset given its risk and market interest rates. And I will turn to the risk defined. In the context of business and finance, risk is defined as the chance of suffering a financial loss, but risk is not a loss. Risk is only the chance to suffering a loss. Asset or financial, which have a greater chance of loss, are considered more risky than those with a lower chance of loss. Risk may be used interchangeably with the term uncertainty to refer the variability of returns associated with a given asset. And now we will turn to risk preferences. Risk preference refers to the attitude people hold toward risk. There are three types of risk preference. There are risk-averse investors, risk-indifferent investors, and risk-seeking investors. The first one is risk-averse investors, refer to those conservative investors who prefer the preservation of capital over the capital gain. They are unwilling to accept risk in their investment. Usually, they only accept low-risk investment with low return. The second one is risk-indifferent investors, also called risk-neutral investors. They evaluate investment alternatives by focusing solely on potential gains regardless of the risk. Simply speaking, as long as the investments can provide the returns they want, and they will invest, no matter the risk is high or low. We may say risk-indifferent investors don't care about risk, they only care about return. And the last one is risk-seeking investors, refer to those aggressive investors who prefer the capital gain over the preservation of capital. They are willing to accept high risk in their investment as they only aim for high return investments. Now I will turn to risk of a single asset, and the first one is standard deviation. The most common statistical indicator of an asset's risk is the standard deviation, which measures the dispersion around the expected value. And the last one is risk of a single asset. Coefficient of variation. The coefficient of variation, or CV, is a measure of relative dispersion that is useful in comparing risk of assets with differing expected returns. So yeah, that's it for me. Wassalamualaikum warahmatullahi wabarakatuh.